highest. So you have to understand that too, that when you see a pre-qualification letter, if you've got a client that is tight on those debt to income ratios, if you're having that discussion and they're trying to max it out, you've always got to go back to what that total payment is, because it's debt to income that system is weighing out. And when we add HOA, when we have higher taxes, you know, maybe the homeowner's insurance is higher because of a certain house in a certain area, a certain property, certain size of a house. You really have to be careful with that and know, is my couple or is my individual capping out? And if they are, I really need to know that. Does debt to income include open credit? Greta asked. No. So when we pull your credit report, we're going to actually see what your payment is on the, and that's a good question because we can go to debt to income and how we change it. What's your minimum payment on that credit card? What's your payment on the car loan? What's your payment if you're keeping your mortgage? On a mortgage, if they're keeping a house, we have to look at, do they have an HOA? Are they escrowing for taxes and insurance? So when we look in the credit report, another analysis is done.
Okay.
And if
we're almost finished.
If they have, let's say, a car loan and they only have 10 payments or less, or they're close to that, a lot of times we can tell them, hey, if we pay down this car by 2 payments, get you down below 10 payments or less, we don't have to count that car payment. So that will help their qualifying. If they have credit cards, sometimes, you know, we're going to need to, because we're taking student loans in consideration, we have to do a calculation payment on that. It usually we go with the Freddie Mac program, and we do like FHA has changed to only 0.5% of that payment. But looking at credit cards, sometimes we'll say, you know what, you just need to pay that credit card off. And what we'll look at when we're doing this consultation is which credit card has the lowest balance, but the highest payment, or which installment loan has the lowest balance and highest payment. So we're consulting with them going, if we reconfigure your debt and use more toward getting your debt down and less toward down payment, sometimes that really opens up the sales price that they want, or a higher sales price to get them into the house they need. So again, it's a consultation on, okay, what price range, what payment range do you want to be in, and how can we get you there? And that's during the pre-qualification, pre-approval consultation. Alimony and child support does count. It counts as income under certain criteria, but it also counts as debt. So we do have to have that. And Greta just asked that question. So we do ask that question, you know, are you obligated for that? If we're in the process and this is the nightmare and someone just decides to go out and buy a car, the last thing that happens toward closing is there's a light credit pull on their credit. It's going to be uncovered. They're going to see the inquiry. We're going to have inquiry, and we're going to have to know what that debt is. And, you know, it happens very rarely, but sometimes it does show up, and it eliminates them being able to close and ever or possibly restructure the loan. So that's a great conversation to always have with your clients. No changes in credit. No one pulling your credit now. No consideration on new credit. If you're changing anything with credit, talk to the lender first. Any questions about conventional?
Kathy, can you talk about how shopping around for a loan affects their credit?
I sure can. It's just like a car. If you have a client that says, I definitely want to talk to multiple lenders, they should have that credit pull within the same week, hopefully the same day, so that every lender is getting the exact same credit, because your credit score is affected after, they say, a 30-day window. So let's say they pull credit with Quicken 2 weeks ago. We're fine with pulling credit. It's not going to be another hard credit hit as long as we're in that 30-day window or less. We may get a new credit score though. We may get a different one. It's not because credit was pulled by another mortgage lender, but maybe something changed on their credit report. Maybe they charged more on their credit cards, or they paid down their credit cards, and it cycled through the system where it was updated. So we see a higher debt, we may see a different score, or a late payment popped up after that other lender. So again, if they're going to shop, have them shop up front when they're pre-qualifying, have everybody pull at the same time. Credit reports for conventional loans are good for 4 months. So once that credit report's pulled, if there's no incident on there that we have to update for any reason, like them getting new credit or, you know, buying a car, selling a car, whatever, then we can use that credit report from the day of we pull to the day of closing. We can do that in a 4-month period and not have to re-pull again. Any other questions about the credit?
Alec, if you'll let me, I will share my screen and I've got the conventional loan contingency pulled up and maybe we could walk through this.
Okay.
Yeah. And Kathy, you know, if going back a little bit to the first, you know, what qualifies someone as a first-time home buyer, you know, you would think that it's as simple as if they've never bought a home before, but really it's if they have not owned a home in the last 3-year period. Is that right?
Right. 3 years.
Yeah. So they can have owned a home before, but as long as they haven't owned one in the last 3 years, they would still be considered a first-time home buyer.
Right. Greta, on the alimony question, every loan is different. Now, Fannie Mae, I believe it is a 6-month period of receiving that alimony, it being continued for at least 3 years from the closing. So that's a key too. If you've got someone that's about to get a divorce and they're trying to set everything up that they want to use and qualify, we really need to talk through how they structure it, because the attorneys don't know mortgage lending. And if they set up alimony that stops in 2 years, we can't use it as income. If they set up, you know, the child support, we go by the, you know, the child and their age. You know, if it's going to be stopping in a 3-year window, if that child is 15, you know, and at 18 it stops, then we can't use that income. So I've counseled, I actually have a number of divorce attorneys that have people call me to discuss that on how to set it up before they finalize the divorce, you know, because instead of getting large alimony payments for 1 year, you know, stretch it out for 3 years if you want to use it to qualify. Just information like that.
Any other questions? Okay, so what I'd like to say is when we're working with a buyer, one of the very first things that we should do, and this is for new people, is to contact our lender, right? Because we can't put together an offer until we know the information that's on this. If we're doing a conventional loan, we can't put together an offer until we know what this is. And this is a protection for our buyers. So Kathy and Alec, could you talk a little bit about what these mean, like the percentage of the purchase price, the years, the percent per annum, whether it's fixed, adjustable, interest only, institutional, and that kind of thing? I can talk about those, but I'd love to hear what your insight is.
You need to share it, Candace, where we see the document now. It went away for some reason. We just see your FMLS and your statement on.
Because I moved it to a different screen. Hang on one sec.
But that's a really cute dog, Candace.
I
So
know.
Thank you. That's Monroe. She was a good girl. Now, can you see it?
Yeah. Alec, you want to go over it?
Yeah, I can. And Candace, I don't know if on your screen you can zoom in, and maybe I actually can.
I don't know how. Okay, you're younger than I am, and I don't know how to zoom in.
That top, look at the top middle. There's a
Oh, I see. Okay, thank you.
magnifiers.
Oh, I thought it was something with Zoom.
And then take your screen and widen it. You can take it and grab it maybe.
Got it. See if I can grab it over here.
And that should be okay. I can.
How about the top right? This little, does that?
Thumbnails. Can everybody see? I can scroll, like if I can scroll.
Yeah, that's fine. I can see that and then have you scroll. So yeah, so looking at block A, so that's just going to be your first mortgage. So you're going to put the percentage of the purchase price, so your loan to value. So if they're putting 10% down, you would put 90% of the purchase price. That's going to be the first mortgage attached to that property. Term is if, you know, that's going to be 30-year, 20-year, 15-year, whatever they decide. And interest rate, what you're putting there is typically what they get pre-approved for. Sometimes that rate changes depending on when it's locked in. But typically it's going to be whatever that pre-approval letter says. That's the number that goes there.
And you may have some listing agents that'll come back at you if it's 2.99 and say, well, we want to make sure they'll still buy the house if it goes up to 3.25. And they may counter back with a higher rate. So just be ready for that. We see it all the time.
So explain that a little bit more, because I know for people who aren't in this world a lot yet, that sounds mysterious.
Yeah, these terms are very important because what you're putting under contract, remember it's contract, is that if your buyer can get a 90% loan, like Alex said, that's a 30-year fixed rate at 2.99, fixed is the next, institutional is the next for us, then they're going to buy this house. If the listing agent is savvy and they know the market, they're going to say, no, we want it at a 3.25. If this market goes up before they lock in, they're still obligated to buy this house, even if they have to take a 3.25 rate. So you may see that.
And you put market there?
I've never seen that. It's a rate. I mean, market rate is so subjective. If you want to protect your buyer, you want to have the rate. What if the market rate goes up to 18% in a week?
Mm-hmm.
Couldn't go up. I mean, it couldn't, but it could go up to 6. I mean, we've had, and again, 38 years in the business, we've had a swing. And this was a market in 08, 09 that it went from 4 to 6 in a week. So you really need the real rate range in there.
So that means if you have a rate in there and the rate goes higher, they can get declined because
if the lender says that rate's not attainable to them, and again, rates can be bought down. So I don't know, that would be a good Melba question. It's like, well, what if the seller says, fine, I'll buy your rate down, or, I'll pay the points to get there if the buyer doesn't have it, then you're going into it. But it is saying that is the rate, that if they have to get that rate, they will take that rate and they will buy that house.
So what's important to know about this is that there's 3 different places on this, well, actually 4 different places on this form that protect your buyer's earnest money. This is one of them.
Yeah.
This is the first. And then we're going to look down to approved mortgage lenders. We're going to look down to appraisal and also financing contingency. So, okay. So can you explain the difference between fixed, adjustable, and interest only, and what you're seeing, if you're seeing any of those? I haven't seen adjustable or interest only in a long time.
Fixed is what it is. It's a 30-year fixed rate. Adjustable, we do have adjustable rates out there. Usually it's, a 3-year adjustable rate or a 5-year. It's an inverted market right now. The adjustable rates are not any better than the fixed. So you're probably not going to see those unless it's a special program like our Smart Series. If it's a Smart Series, a self-employed or something of that nature, they may choose to do an adjustable rate. And then interest only is exactly what it says. Usually that's only going to be a program. Again, I haven't seen it in the market for standard purchases, but I have seen it on the second mortgage side. So you're usually, if you see interest only, you're going to see it on that second mortgage B. And the institutional is us. It's any lender. Seller could be the mortgage holder, or it could be another party. It could be a hard money lender.
Thank you. And then I haven't seen second mortgages filled out, I don't think ever, maybe back in the early 2000s, but I haven't seen that in a long time either. Have you?
Yes. And unfortunately, even though buyers are getting second mortgages, a lot of the agents aren't filling this out.
Okay.
So combination loans, we can do, someone could put 5% down and do a 15% second mortgage to get rid of PMI. A lot of times people will do that because they know they're going to be getting an inheritance or they're getting bonus money, and they're going to knock that second mortgage out and they don't want to end up dealing with PMI. So normally,
what PMI is?
Yeah, private mortgage insurance, like we talked about yesterday. MIP is the government insurance that protects the lender upon default. PMI is the government insurance that protects the lender upon default. If your buyer goes into foreclosure, the foreclosure takes place, there's a loss on that mortgage, this private mortgage insurance makes the lender, the institution that they're paying to, the servicing company, whole. It doesn't protect the buyer at all, doesn't do anything for them. So that is one of the ways. And again, it'd be the same thing. We'd have to do the loan to values in there. You know, is it a 10-year mortgage? Is it interest only? Is it adjustable? You know, what's the rate? You would have to have all of that information from us if they're doing that combination loan.
And is there a protection here for filling this out for a buyer? Or is it better to leave it blank?
Well, if the buyer doesn't have it in here and they can't get the second mortgage at the rate, I mean, it's just like the conventional. If they can't get it, this is their out. If it's not in here and filled out, let's say you put in there that it's a 95% loan, but your buyer's getting a 90 and they don't qualify to 95, they're not protected. You've
Okay.
got to know what they're doing. Is it a 97? Is it a 95? Is it an 80? You know, what are they doing and what are they qualified for and what are they willing to do to buy this house? So this is very important. You know, we see agents, it comes through and it's already filled out by the time we get the contract. They don't call us, they just fill it in and we're like, okay, you know, we'll close them. Fortunately, we pre-approve them, so we're going to close them. But if it's that lender that hasn't looked at it thoroughly enough and this isn't filled out properly and they get turned down after financing and it's because of some of this and it's not filled out properly, you haven't protected your buyer.
And
So
that's,
Kathy, we're doing a lot of, bridge loans right now. Is that also going to go in that second mortgage loan, or is that only if the second mortgage is
No, the bridge,
done?
the bridge loan is attached to their current home. So it's not a part of this mortgage transaction in the sense of this document. What I do suggest to agents is put a special step though, that their buyer is, all their assets are coming from a bridge loan and it is subject to that approval.
so what I'm hearing is before you take a buyer to see a home in case they fall in love with it and it's, 9 o'clock at night by the time you get home, before you ever do that, have them contact a lender and help them to understand what these are, get this information from the lender so you don't have to disturb them at 9 or 10 at night and you've got this ready to go. Because this isn't, I think we think of this as like, oh gosh, we've got the purchase and sale and now we've got to do that stupid loan contingency. But it is an important protection for our buyers and to be agents who are using best practices, to be knowledgeable about this and to be proactive about this, I think is a must.
So can we typically pull that information from the pre-approval letter, or we still have to contact the lender even if we have a pre-approval letter?
Yeah, what we do, Donna, is we send not only the pre-approval letter, but a worksheet that breaks down what we've done. So it's going to have it on there. You're always welcome to call to make sure, especially if it's someone's very tight in ratios. But our pre-approval letter and worksheet. So what you want as a buyer's agent is you want to get that from the lender. Give me a detailed worksheet on the rate range, the down payment, the loan to value, if it's a fixed rate, along with your pre-approval letter. As the buyer's agent, you have the right to push to get that from your buyer.
And I'm not sure all lenders understand how this does protect buyers. So I've had lenders who just throw out a rate because they don't want to dig deep. And so you have to, it's a reason why you want to try and guide your buyer toward a lender who's going to do a great job. And that's a shout out to Shelter, and I'm not ashamed of it. It's
Well,
a serious
and
plug.
again, as a buyer's agent and you've got the right to push to talk to that lender. Tell your buyer, I want to protect you. I need to be able to have a relationship with your lender too. We've got to do this together. This is, especially in this market, this is a team effort to protect you.
Hey, Kathy, this is Chris. I had a question in regards for the pre-approval with underwriting. How much time are you typically seeing it saving buyers, and how much more attractive, if any other agents are seeing that with the pre-approval with underwriting is being kind of taken into consideration?
It's big, Chris, all the time. In fact, I did it for 2 contracts this weekend. I actually call the listing agent. Alec or I will call the listing agent. So we're given a pre-approval letter that says we've looked at credit, we've looked at income docs, we know this person is vetted, but we call them too. And we tell that listing agent, hey, we are local. We're going to be local underwriting to get this unit closing on time, local appraisals. This whole process is local and we've already vetted them. We've looked at everything. We've got an amazing buyer, you know, their salary, no concerns at all, or they're self-employed, but we've already got it underwritten. It's huge. And a lot of the listing agents are so shocked that they get the call from a lender on a Saturday night or a Sunday, and that the lender's giving them their cell number, and, you know, we're going to keep you informed. We're going to give you, proactive communication throughout, any questions you and the seller have that, of course, I can give me a call. It's big. It's a big deal. I'm telling you, if you've got a internet lender like Quicken or Rocket Mortgage, whatever they're called now, against me, and it's the same terms or close to the same terms, my client more than likely is going to win the deal. And the listing agents will tell me that. You just push them up to the top of the stack.
So in regards with let's just say hypothetically speaking, these newer agents like myself are putting financing contingencies, with it being all the way through underwriting, what would be a typical timeline? Like, typically most people are putting anywhere between 10 to 14 days. Would something like, could we do even 7 with financing? That way we look almost just as attractive as a cash.
With a client that we've already vetted, Chris, that's a stellar client, we don't ask for financing contingency. We're good.
Awesome.
So if we go down to the use of a particular mortgage lender, and I'd love your clarification on this. I've always been told to leave that blank, because if
I'll tell you why.
Yes.
If you leave it blank, your buyer can be turned down by any lender and be protected within the financing period. If you put just us, we're the only lender that can turn them down to validate that they didn't qualify. So as the listing agent, you never want it blank. As the buyer's agent, you may want it blank. There's a rule of thumb to think through too, though. If you have Shelter Mortgage, Kathy Vitali, Alec Jones, and we're calling the listing agent and we're solidifying how strong, and your buyer's already vetted, that's going to strengthen the contract versus being blank or versus being a lender that they're not familiar with. So, there's 2 thoughts to it, and a lot of agents do it differently. I have agents that definitely put our name, put not only Shelter Mortgage, but put my name, put Alec's name, put the phone number, and they're very specific that, hey, we use this lender, used them for 10 years, whatever. They're a alliance partner, and they push the fact that it's a lender that's local, that will be handling the whole transaction. And
very honestly, during the transaction is not a time for the buyer to be shopping for a loan. So I think some of us have talked about that. We've had experiences where, as the listing agent, the buyer changed the lender in the middle of the transaction and it delayed the closing, and the seller's only option was to walk away and put their home back on the market, which wasn't a great option, because they had based on the contract, put a contract on another home. So try to encourage your buyers to do their shopping before you get under contract. And if you can put them with a strong lender like Shelter, like Kathy and Alec, then that's a plus for you, because they'll feel good about it. Any other questions about this part of it? Okay, so if we go down to 4, this is the, 4.5, the financing contingency. Let's talk about that a little bit. If you all would shed some.
You've got to know what your lender can do, y'all. Sticking a date in there and hoping they can meet it is not the way you work this. You've got to know your buyer's situation. You've got to know how many days they need. You have to have a relationship with that lender to have that discussion. Again, most people are only putting 7, 14. I am still seeing some at 21. But you've got to know where that buyer is with that lender and what they're willing to do. How can they get them through underwriting if they need to in that period of time to protect your buyer?
And the other part of that is your buy, because it's not just on the lender, it's on the buyer. Is the buyer getting documents in a timely manner, or are they somebody who procrastinates? And that's a conversation to have with your buyer as well.
Yeah, is there a document that they haven't received yet that they're going to have to get to really truly be pre-approved? I mean, there are situations where there are documents we have to tell you, hey, we can't waive it because they've got to get this done. They've got a 401k that they've got to know they can pull this money out of. They've got to get that done. You know, we'll let you know that.
Any questions about that? Any comments? Okay, so then we're going to go down.
I have one.
Oh, good. Thank you.
I'm sorry. It took me a second to get my button pushed. So really and truly, these protections are if you want to make your contract look stronger or if you want to protect a buyer. So really it's knowing your buyer.
Yeah.
Is that what I'm hearing?
Yeah. You got to know your buyer, and you've actually got to know the lender that they're working with to know what they can really do.
Yep.
And if
So
you've got a lender that says it takes me 30 days for financing and 30 days for the appraisal, they need to get a new lender.
It's probably not a local lender.
Probably not a local
True.
lender, probably a bank, maybe a credit union, but you've got to know that. You've got to get that lender on the phone and say, okay, I'm putting in the contract, so you're guaranteeing me you're going to meet this date.
So there are those of you who have heard this, but one of the things I say when I work with a buyer is, listen, your lender is a really important part of our team. I have 5 criteria for choosing a lender. 1, they have to be local. They have to know our market. 2, they have to have competitive rates. 3, they have to be responsive. If they can't answer their phone, they get back at least within 24 hours by email or text or phone. 4, they have to give us regular updates without us chasing them down, because it can seem like a long time during underwriting with nothing happening to the buyer. And there's always some doubt. It's always like, is there something I forgot? Did I not pay that bill? And it's stressful for your buyer. And the 5th one is if they cannot attend closing, they at least can be available. So if a T is not crossed or an I is not dotted, they can be available to address the funding issue. And that after you say something like that to your buyers, more often than not, they're like, well, who? And then you have that, you can guide them into a relationship with a lender that's going to be beneficial for them instead of one that's going to cause both of you to have to get hair dye.
Candace,
Alec,
sorry,
ahead.
quick question. I've never had a lender attend a closing. Is that common?
It used to be, but not in this market.
No, not in
Lenders are
COVID. Not in COVID. I mean, when the pandemic hit, the attorneys were like, and still to this day, the least amount of people at closing, the better, and the least exposure. We love to go to closing. I mean, I used to try to at least get to the very end of it because that's the celebration time, and usually that's the only time we get to meet the buyers. But now, you know, still with the pandemic still being, especially now as it's escalating, as we know with Alec and his wife, no, we're not attending it unless there's a situation and the buyer just really needs us to be there. You know, if they just have that comfort level to be there, we're going to make it time to be there.
So we've got about 3 more minutes. And I want to just say, for the first person who posts an aha in our PC announcements, they're going to get this book that Ryan has vetted at $1,000. I actually bought it for $7. But you can get this book for $1,000. So the first person who, and don't do it right now, it has to be after we get off. But the first person who posts an aha about anything you learned today will get this book. So let's go down to 11, the appraisal contingency. Can you all just speak real briefly about the appraisal contingency?
We lost your volume, Candace.
I'll put it in chat.
There we go. You're back.
Okay. Can you just briefly speak about appraisal contingency?
Yes, appraisal contingency is really going to depend on the buyer and their execution and the lender. A lender cannot order the appraisal until the loan is fully disclosed. So disclosed means that we've got the contract in hand, we've put it in our system, we've locked in the rate, we've pushed a button to disclose the contract details. The buyer has gone online, they've e-signed through and accepted those terms. If you write a contract and you put, because we will do a 10-day rush on appraisals, but you hold that contract and don't give it to us for for 3 days, we're not going to make that 10-day period. So be very, very conscious. Even if there's signatures missing, the day you go binding, that lender needs that contract. And they need to know, hey, I did what you said. I've got 10 days. The problem also comes in, you do this contract on a Friday night. We don't start working on this in the sense of disclosures and lock-ins usually to the Monday. You can do it on the weekend, but it's sometimes not exact. So be very careful with the days that you say that appraisals come in. Don't ever put your appraisal contingency date or financing contingency date on a Saturday or a Sunday. You're just making yourself work on the weekend. And lenders don't work on the weekend usually. We do, but an underwriter's not. So if you put in a financing or appraisal contingency on the Sunday, it has to be done on Friday. It's not going to be, Sunday's not going to get it. So look at your calendar days when you start putting this number in and know what your lender can accomplish.
And I have one more question, and this was one that was asked to me. So what is the process for the closing disclosure, also known as a CD, in the 3-day period that it has to go? How does that work? Does it go to the buyer and then the attorney? How does that work?
So up front, it's called a loan estimate. So we have to do an LE up front. We're putting in the contract information, locking in the rate, closing date, all the attorney that you've chosen in the contract. We need to know that because all attorney fees vary a little bit. So we're disclosing the closing date and everything. That's a loan estimate. They have to sign that before this appraisal. Before we can move forward, they're saying we're engaging with your lender. At the end, it's called a closing disclosure. So we've ordered title with the attorney. They've pulled the title in. They've got all their fees that they're adjusting in. It may be an HOA fee. We're adjusting all our fees. They paid for the appraisal. They now got our insurance policy. So we're doing an estimate usually at that point, not 100%. It's called a closing disclosure. We actually kick that out 7 days prior to closing to make sure that we're not in any way jeopardizing the closing because we don't get a CD out in time. A closing disclosure has to be e-signed through by the buyer 3 days prior to closing. Sundays don't count, legal holidays don't count. And we can actually send you, Candace, our flyer that's our cheat sheet on it.
Okay.
So what you want to do is you want to make sure that your buyer, if you're the listing agent, that buyer has e-signed through the closing disclosure a minimum of 3 days prior to closing, or because for no reason at all, there's no reason at all except for the seller going into foreclosure, I think is the only reason they'll escalate that. If you can't close, I mean, no matter what is needed, you can't close any sooner if that thing's not signed properly. If it's not executed all the way through, you're not going to close. So you have to have that on your checklist as a listing agent and a buyer's agent. Is that CD signed? Can someone at the lender's company confirm that they've signed it so that we're headed toward closing?
I'm just saying, this is such a valuable, thank you for this. And we're so excited you're going to be with us for the rest of the week. Does anybody have any questions before we go? I feel like we're getting the mystery of loans exposed so that we know kind of the backstory to it. And I have lots of ahas, so I hope all of you do too. Anybody have any last questions or any comments that you'd like to, and I'll just wait a second to get off mute.
Hi. So what happens when there is an appraisal, there's no appraisal contingency, and the appraisal, obviously if there's a lender, there has to be one, and it comes in low. And let's say that there's just a crazy scenario where it does not appraise and the buyer is not able to come up with the shortfall. They are obligated legally to, and then basically they'd be subject to be sued under contract if they don't go through with it. Is that correct?
They've lost their earnest money and you've actually written a contract that they're not holding to, and it is a contract. So yes, you know,
Okay.
you're putting them in potential litigation.
Got it. Thank you.
We can waive appraisals. We didn't talk about that on conventional loans. If they're putting, I think it's 10% is the least I've seen, but usually it's at least 20%. In our automated system where we get them approved, the Freddie Mac or the Fannie Mae system, we actually put the address of the house. So it's on a weekend, you're putting an offer in, you're like, Kathy, they love this house, you know, Alec, you know, whatever. We run not only their updated information to give you a pre-approval to match that sales price you're offering, which we do. We put the address for the house in, and if there's enough comparables for that house, our system could waive the appraisal completely. So you may see as a listing agent or as a buyer's agent, a 0 appraisal contingency because we don't need one. The system has given us one.
Excellent. Thank you so much, Alec and Kathy. We just are so loving this whole week. And I know I can speak for everybody because these are questions that, I mean, some of us don't even know to ask. So thank you. And we'll see you tomorrow morning. If anybody has any more questions, just send them to me in the WhatsApp, and I'll make sure we get them to Kathy and Alex so they can answer them tomorrow.
And
Thank
we'll
you
dig
all for
into
being
VA
here.
tomorrow. VA tomorrow.
VA tomorrow. Thank you all. Have a
Have a
great
great
day.
day.
Thanks, Kathy. Thanks, Alec.
See you at team meeting later.
Alec,
Bye, guys.
Thank you.
Thank
Bye.
you.
Thank you.